Let's get going on our last and final time. Dry your weeping eyes together. We're going to spend a little bit of time today getting you guys prepared for what hopefully is a skewed exam result on your final next Thursday. We'll talk a little bit about the logistics of that. If you downloaded the notes an hour ago or 30 minutes ago, I posted an updated rev of that because a lot of the quiz solution materials are actually lifted from the last quiz, and I was trying to overlay that, kind of some modifications from this quiz, and so there's some duplication errors that I think I have fixed now based on what's out there, but you can just make note of them as we go if you downloaded those a little bit ago. Just a brief recap of what we talked about last week with just-in-time and the Toyota production system. We spent some time talking about how the traditional kind of cost accounting mechanisms are really geared towards stakeholders that aren't necessarily operations managers, right? They're geared towards financial reporting to stakeholders like regulators and loan managers and stockholders, but not operations managers who are trying to make trade-off decisions within the organization, right? And so in order to truly understand what some of those trade-off decisions might be, as far as investing in incremental sales or incremental, if there's a customer that we want to invest in or new product lines that we want to invest in, understanding the contribution margin with those segment-level characteristics, either product segments or customer segments, are important. And we went through an example of kind of how to structure an activity-based costing model in a very, very simple way. And the key thing is trying to contrast the results that are revealed from an activity-based costing model, which segments are consuming which resources, versus a very traditional costing allocation model, which basically uses simple things like revenues or cost of goods sold or labor hours as the allocation mechanism. Also talked a little bit about just-in-time, the big picture of what it is and what it's not, and kind of contrasted that to the Toyota production system. Some key takeaways on TPS, right? 3 managerial components, the philosophical, managerial, and the technical. Most people focus in Lean just on the technical components. The Toyota folks would say those other 2 arms of that triangle are as equal, if not more important than the technical components. Key is to start small, go deep within that, and then expand out. We talked about an initial pilot taking 4 to 6 months, but really penetrating the organization is often a 9 to 18 month journey, and then those lessons get rolled on. Key is to have leaders that are in place to develop problem solvers. That's probably the most difficult aspect of TPS, right? Having something sustainable after the consulting experts leave, right? And the ability for something to be sustainable is to have that teaching component where you teach people to solve those problems on an ongoing basis, right? And things I don't think we specifically talked about, but these were an extract of some of the kind of observations that Jamie Bonini, who is the kind of senior VP with the Toyota Support Center, who kind of leads the consulting organization for TPS, right? After doing this for 15 years, oddly, he believes there's still an insane amount of opportunity to adopt these principles in the North American market. Lead time excellence is a competitive advantage. So we talked about that in the second week, right? Trying to identify business models that have a competitive advantage, implementing the Toyota production system as a philosophy, and gleaning those consistent lead time advantages over competitors can be differentiating. Well, we're talking about this as an ops management class. TPS is really a corporate rather than an ops strategy, predominantly because of the philosophical and cultural aspects of it. If it's not really imbued within the organization, then those efforts tend to die over time. You learn best by doing, just like riding the bike, right? You can have workshops, you can have case studies, but really, Jamie believes 80% of the progress is actually done by doing. And again, kind of underscoring Lean is not TPS. Those are 2 different concepts. A couple other things I want to underscore before we move on to the quiz and move on to the final. Traditionally, when we view Lean, right? Traditionally, there's kind of a trade-off between the setup costs and the holding costs of an organization. And as you try to drive smaller lot sizes, the benefits of the lower holding costs on smaller lot sizes are often eroded by the increase in changing the line over and changing those setup times, right? And so while lean tries to drive that small batch size, the only way that's really enabled is by that pit crew concept where, yes, we're going to try to drive small lot sizes, but we do that through really accelerated changeover times to get that new optimal lot size. So with that, let's talk about the quiz. So what we have here are side-by-side comparisons of your class, the Tuesday-Thursday section, with the Thursday night class. Markedly better, even though the average grade for each class was a D. It's markedly better because I think the average grade on the original Quiz 10 was, in the 30s or 40s. So we're making progress. But even so, after 2 iterations, that's not the best result. And so we will, and what you have seen, both of those results curved up. And so some of you who aced this have a little more than 100%. But I think on average, these were curved a little less than 1 point each to get the average class grade to a C. Let's walk through it. So what you'll see on these slides are the original questions that was originally in Quiz 10, and then some annotations on what changed, right? Because what I wanted you to do is not go, oh, it's the same quiz, let me just pick the same answer. That was not the intent. The intent was for you to understand that these were a framework of questions, but the data is different, and you're often going to get different answers. And so if you simply said, oh, let me pick the largest lot size, that was the wrong answer because we changed dramatically the inputs to this problem, namely a 60% carrying cost, right? We're holding diamonds in this scenario for some reason, and instead of a 30% carrying cost, we have a 60% carrying cost. And the old answer was, I think 90 units was the correct answer, the biggest lot size, but in this case, you had to choose the third lot size of 70 units, and we'll talk about why, right? Taking a lift straight from the notes of the volume discount scenario. So typically, when we're looking at quantities, we're going to be looking at things for the economic order quantity, right? And there's going to be lots of questions where I give you demand, I give you carrying cost, I give you the price or the value of the inventory, and I give you the order placement costs. And I'm going to say, tell me what the optimum order quantity is. That is the EOQ. But if you then see other data like, hey, there are price bands for different quantities, then you need to be jumping to the volume discount model approach, right? And so calculating the EOQ is the first step. And so if you had calculated the EOQ, got 37, saw that as one of the answers, you would have been wrong because while that's the first step, that is not the last step in this model because we have multiple price bands associated with this problem. And so I start with the EOQ and then I have to figure out, are there price bands I can eliminate? I cannot because 37 falls within the very first price band, so I got to evaluate them all. And then I use the purchase cost element or add-on to the total cost formula where I look at the order placement costs, I look at the order carrying costs, but then I also look at the purchase costs associated with each model, and there are 4 of them. Let me move my reef polling side up here. And what we see is 4 different scenarios, and let's walk through what changes in each of these 4 cost models. The first is the quantity, right? So if I look at the order cost component, right, the demand times the order placement cost divided by my quantity. So you'll see in the first parameter, the only thing that changes is the order quantity, the original EOQ or the bottom level of the price band for each applicable discount, right? So 37 was my first one, but then I could order 50 and get a discount to $23. I could order 70 and get a discount to 20 bucks, or I could order 90 and get a modest incremental discount to 19.5, right? And so you'll see that the quantity is what changes in each of those first parameter buckets. The second group is the same because this is the constant carrying cost formula, right? Carrying cost is the value of the inventory times the inventory carrying cost percentage, right? And so since this is the constant carrying cost scenario, you'll see that the only thing that changes is the quantity that we're holding. Again, 37, 50, 70, 90. The price has no implication to the carrying costs here. If we were doing the other problem that hasn't been on any of your quizzes, but we said, hey, we're going to evaluate a variable carrying cost scenario, then yes, the value of the inventory would change based on what you paid for it, but under the constant carrying cost scenario, those are static. The third element that changes is then the total purchase cost, right? So the quantity of 200 times the price that you're paying for it changes. And in the original quiz, it made sense to buy the most, right? I think the original answer to the first quiz was to buy 90 cases. But because of the model input changes of namely a 60% carrying cost, what we find is that the very, very, very modest incremental savings that you get by buying a little bit more is offset by the carrying costs, right? And so you get 4668 under the 70 case scenario. You get 4686 under the 90 case scenario, and that's why simply choosing the largest bucket wasn't the right answer in this question. Okay. So we picked parameters that tested your understanding of the approach, not your understanding of, I always pick the largest quantity, because that's not always the case. Questions? All right. Originally, y'all got 20% of you got this right. So the fact that 41% of you got it right, that's improvement. I would like to see this closer to 70 or 80%. I'd love for the final to be so poorly, such a poor instrument of your understanding because everyone got it right. Right? That would be an ideal circumstance because we've definitely tested twice now that not everyone gets these concepts. So we'll try it one more time. We'll see this again on the final. All right. On average, you guys got almost a B on this one. Again, we're trying to find the good deal quantity, right? So we know that the equation for understanding the good deal quantity is a function of the original economic order quantity. So I got to know that. But I also have to understand the difference between the standard value of the inventory versus the good deal price or the good deal value of the inventory, right? And under this scenario, we said there was a 10% discount. And so 10% off of 60 is $6. And so 60 minus 6 is $54. So now I have my parameters for the original price of the inventory and the good deal price of the inventory, right? Once I get that, I can plug and chug that into my standard EOQ model. Again, we used 4,000 units as an input to this rather than the original 3,000 that was in the original quiz. We got a slightly different answer for the EOQ. But then when I plug and chug those variables, we get almost 1950, almost 2,000 as the quantity. Okay. Questions on that? All right. The next question is the savings. I think the notes that were posted an hour ago actually had the wrong answer here for savings because it was just a duplicate error from the original quiz. But I think I've updated that based on what's out there now. 65% of y'all got this right. Again, we're using 4,000 units as our quantity, not 3,000. We have to understand that the good deal value of the inventory was $54 versus $60. We had to understand the original EOQ and the good deal EOQ, and we plug all those numbers in and we get $4,730. Okay. All right. Reorder point. The reorder point is a function of the demand during the lead time and the safety stock. Safety stock is a function of the standard deviation of demand and how many multiples of that standard deviation of demand we want to hold on the shelf, right? That's our K factor. So the first step in understanding the reorder point is understanding what our service level is. Up in the problem statement, we define an 80% service level. And so we dive into the normal table, the standard normal table, look for something that's really close to 80%, and find what K is. And in this particular scenario, we find that K is 0.84. And so if K is 0.84, we know that our standard deviation of demand was a given of 200 units. We adjusted our annual demand from the original quiz from 156,000 to 130,000. We adjusted our lead time, and that also resulted in a new EOQ. And so when we plug our 130,000 annual demand, get that on a weekly basis divided by 52, scale that up for 2 weeks, add to that the safety stock, we get around 5,200 units of, when our quantity hits 5,200 or 5,168, we enter another order. Yeah.
You get the 130,000 units working 42 in 2 weeks again.
I just changed it. Right? So on the quiz, instead of it saying 156, the quiz said 130. Right? So the original quiz, the one that everyone bombed, had 156,000 units of demand in 3 weeks. Because I didn't want this to be a pure just copy and replace exercise, I changed some of the problem inputs. Namely, on this quiz, it was 130,000 in 2 weeks. Right? You'll see that on the exam. One of the things we're going to see on the exam is that no single exam will be the same. Sage may see a problem with 155,000. David may see a problem with 140,000. Each of those has its own unique answer. And so calling a friend, asking them what's the answer on question number 2 isn't going to help. Okay? All right. Expected units short. Expected units short is N of K times sigma. Right? That's our statistical approximation for the probabilistic view if we wanted to do that. Right? In order to get N of K, I've got to get K. There's this dance in between these two statistical tables. And so the first thing I have to understand is that the problem definition said there's a 80% service level, so I jump into the normal table, and for an 80% service level, I get a K of 0.84, just like we did on the first exam, or first quiz. Again, your service level might be a parameter on your final that's different from test to test, right? So each of you may be hunting for a different K. But once I find that K, I can then jump into the N of K table, or the N of K conversion table, the unit normal loss integral table. And with an N of K of 0.84, I find, or excuse me, with a K of 0.84, I can find N of K is equal to 0.1120, which so far, this is exactly like the first quiz. Matter of fact, I think all of this is exactly like the first quiz. Even though some of the other parameters were the same, I think this was an exact duplicate. And so, again, surprised that 43% of us got it wrong, but expected unit short here of 23 units. Okay. When we're talking about units, right, we got to round up the whole numbers. So that's why we move up to 23. What's that? Awesome. All right, so now we got to know fill rate. Interestingly, one of the reasons we ask about expected units short is it is an input to the fill rate calculation, right? The fill rate is basically 100% minus the ratio of my expected unit short over my EOQ. And so if expected unit short is N of K times sigma, I can run and gun just like everything else. So again, how do I find N of K? I got to start with K. How do I find K? I got to start with service level. And so if my service level is 80%, again, even though all these problems have used 80%, you'll probably not see 80% again on your final, so don't get used to that. 80% here gave us a K of 0.84. If K is 0.84, then N of K is 0.1120. We multiply that by the standard deviation of demand, multiply by our EOQ of 1442, subtract that from 100%, we get a 98.4% fill rate. Okay. So in this scenario, under these parameters, an 80% service level equated to a 98% fill rate. Not bad. All right. Cost of a back order, 63%. Rocking this problem. The only thing that really changed was the cost of a back order went from $70 to $95 in this scenario. And so if the cost of a back order is a little bit more expensive, Then under all those other scenarios, the probability of a stockout rose to 7.5%. 1 minus the probability of stockout is our service level. So if I've got a 7.5% probability of a stockout, I've got a 92.5% service level. I jump into the normal table to say, hey, where is 92.5? That is roughly equal to 1.44. And so what am I looking for? I'm looking for safety stock. So safety stock is a function of K times sigma. So if my standard deviation of the domain was 20 and my K was 1.44, then I get 29 units as my safety stock. All right. Toyota production system focuses on technical, managerial, and philosophical. That was a gimme. Contribution margin should be the things ops managers use to assess trade-off decisions. And then we had our margin contribution analysis problem. First step in that problem was understand we had 3 buckets of costs that we were actually going to do our activity-based costing on. We then had to look at our general ledger, which had all of our costs, and allocate those to the 3 buckets. And so the gray numbers go into the direct labor pool, the yellow numbers went into the machine pool, and the green numbers went into the purchasing pool. Right? So when we total all those up, we can get our kind of cost per pool. And when we divide by the total consumption of 1,200 labor hours, 300 machine hours, 80 purchase orders, we can get kind of a per unit rate for the machine pool, the labor pool, and the purchase department pool. So now I've got this rate that's a truly well understood resource allocated by consumption rate. Now I want to start allocating that to the segments that are consuming those resources. And so widget A consumed 800 labor hours. And so if that's $375 an hour times 700, that gives me $26.25 total cost, right? If I had 100 machine hours at $10.83 an hour, then that gives me a little over $1,000 of machine cost. Do the same thing with purchase orders. Do the same thing for widget B. I'm now allocating that $11,550 of total costs into the segments based on their consumption of our cost pools. Okay, so that's the activity-based costing method of how we allocated the total cost. Under the traditional method, we simply just allocate by labor. And so we kind of ignore everything else. And so I just take that entire cost and allocate solely by labor, and I get a slightly different number of what my widget A costs are versus my widget B costs if I ignore the true resource pool consumption of everything else that's going on, right? But that's how a lot of people do it. They either allocate by labor, or they allocate by revenue, or they allocate by cost of goods sold. But now what we do is we have a side-by-side comparison of the traditional view of things. This is what your traditional finance person might say, hey, costs of widget A are $6,700 every time we sell one of those things. But the activity-based costing view says, no, we actually have a lot more profitability than we think when we sell those, right? That widget A, under the traditional method, is overcounting the cost by roughly $1,600. Don't know. Probably 60% if it was like everybody else, right? So being able to walk through that flow of taking our costs, putting them in a bucket, figuring out what the per unit costs are based on the totals, allocating those per units into the individual segments based on actual consumption, comparing that to a pure labor allocation method and seeing how the answer changes will be something that we'll see again on the final. Okay. We probably won't spend a lot of time on the differences in the Toyota production system, right? Since y'all have got that one done. Okay. Other questions about the quiz? Speak now. Yes, sir.
So if we did better on the first quiz, how does that work?
So we took,
Raise my count?
yeah, so folks ahead of time basically said, I'm not taking the quiz, and and I just ported those points over, but I think I said last week, if you take the quiz, then those are your points. So, yeah. Sorry, bud. But you probably know it better now, I hope. So. Okay, let's talk a little bit about the exam logistics. Because everyone kind of schedules Sage Hall 3 years in advance, me trying to do it in November or April was a little late, right? So you can take your exam from wherever. So that's good. It's kind of like no change of policy. But because there's suspicions of different activities still prevalent in the class, what we will find is a completely randomized exam, right? And so if you're calling your buddy asking for help, it's going to be completely different answers, completely different questions. But it's all based on the same content, right? So if you understand the approach on how to do something, whether or not the demand is 5,000 units or 4,000 units, it shouldn't matter, right? You should still be able to work the problem. It is an individual effort, and so don't call anybody for help. It will be 20% of your final grade. So roughly, as I understand it, all your professional development stuff, all of your class participation stuff, all of your previous quizzes, all that's loaded. So 80% of the course of the class is posted on Blackboard, right? So if you look at your total points and divide by 80, that's your grade as of today. Right, and there's a slide at the very end of this that says, okay, if you're sitting there with 49 points, or that'd be a bad answer. Let's say you're sitting there with 69 points, right? All you can get are 20 more, right? So the best you could get would be an 89, and you need an 89 and a half to get an A. So I'll hope that there's a curve, right? But what your total points are based out of 80, there's 20 left. We'll talk about inventory management. We'll talk about lean. Toyota production system, activity-based costing, fairly straightforward, right? So if you look at quiz 9, you look at the multiple iterations of quiz 10, that's basically the content we're going to be covering. Okay? It's not comprehensive. Yes, Mom? I think either 20 or 25, I can't remember. Gotta get me. Yes, sir. It did not. But it was a good try. So for those that are online, the watching the video or being in class when we had the folks coming for work measurement did not count as professional development. So pull up your reef polling stuff. I had some questions for you. For my Thursday evening section, while y'all are pulling up your slightly different time, you guys p.a.m. I think that's supposed to be p.m. You go at 6:30 p.m. Thursday night for my Thursday section. Okay. You guys are the Tuesday, Thursday section. You go at 10:30 in the morning. Don't get confused. Don't show up at 6:30 thinking you can take the final. Don't call me at 2:30 thinking you had all week, right? You have between 10:30 and 12 for my Tuesday, Thursday class, the ones that are in this room live, you have 2 hours beginning at 10:30 on the 11th to get the exam done. Okay? Yes, sir. How many questions on the exam? Somewhere between 20 and 25. I have to. Yes, sir. You can take it in here if you want to. Yes. Okay. While you're pulling up your reef poll, spot evaluations. This is your opportunity to tell me how awful I am as a professor. Right? How much you hated this class, how this was the worst class and the worst way it was ever taught possible. Or not. You could say you actually take a different approach. Here are the links. You probably have something in your email or Blackboard or MyUNT or something to link to this. About 25 to 30% of y'all have already done this. I'd encourage you to go out and do it. Again, if you would like other folks to teach classes like this, or you would prefer never to have a class like this again, this is the way for you to provide that feedback, because folks do actually look at it. In the meantime, I'd like my own poll here, kind of real time. one of the things I'm debating is whether the lecture time is completely flipped, right? For some of my lectures, I recorded them using this little swivel device, put them up on YouTube. I could do that for the entire class and just have the time that we're together focused on working problems, multiple iterations of the problem, so you understand more of that concept, rather than encouraging you to do that on your own time. The other thing we could do is we could spend a lot more time on the Wall Street case studies, right? We tended to do that sporadically, a little bit hit and miss. Some of you may have hated those, some of you may really like that. But question is, would this class have been better had the entire class been flipped, less time spent on lectures, more time spent on these things?
I never got asked for the Wall Street Journal. I feel like it's like half the class.
So this is your opportunity to say, I was ready. I was ready to be picked on.
That I would have to do it.
Well, that was the point.
Disappointed a little bit every time.
The Wall Street Journal has sold out. If you haven't noticed, it's on the front page.
Oh.
I feel like you need to sort of broaden the scope of sources to look at.
Absolutely. So for the folks on the and so I've done this in other classes. I've expanded it to Barron's, Financial Times, The Economist, other things, and so I'm happy to consider other sources as well.
Also, the economics podcast a lot.
Interesting. Okay, so some of you would like a complete flip. Some of you liked it the way it was, and you didn't want to have to do the work of the Wall Street Journal. That's what I'm reading that. All right, so let's move to the next question. Regardless of flipping the classroom or not, would you have liked more time to be spent on the Wall Street Journal, Barron's, Economist, FT type case studies? So last time kind of blended those. Now I'm just specifically teasing out more time spent on the real world Wall Street Journal implications. I got most of you. Okay. You got enough reading assignments that you don't want to spend any more time on that. All right, that's interesting. But I'd be interested to kind of grade that by if you got an A or a B in this class, did you say yes? And if you got a C or D in this class, did you say no? All right. Did you find the podcast supplements useful or not? Sir?
Was your podcast from there or like the TED Talk?
The TED Talk stuff. Okay. Let me re-ask this question now for the recorded video. Even though if we have a live session, should a copy replay of that be available online? So that's this next question. Okay. Clearly you want to be able to skip class and catch up on it later. Okay, so that's it. So I'm going to, before we delve into the rest of the final exam, a lot of you all may be familiar with this, but something I think is just some interesting tidbits of information that you ought to consider. You all know that, or some of you all know that I run a hedge fund, and one of the lessons I try to keep imparting to my high school boys are the difference between these two charts. The top chart, and the whole point of this is to show the power of compounding, right? The top chart assumes that at age 19, you start putting $2,000 a year in a savings account. And you stop at age 26. And you never put another drop into your savings account for the rest of your life. The bottom chart assumes you wait until you got a good job. And you start, maybe you're 26. We got some non-traditional students, right? So you're kind of hosed anyway, right? But assuming you don't start your savings until you're 26 and you put up $2,000 a year every year from the age of 26 till you retire at 65. If you had started earlier and contributed for just 7 years, you'd have more money at the end of the time, right? If you had the same rate of return on that compounding wealth, and we can debate whether a 10% rate of return on either scenario is useful, and we'll talk about that in a minute. The whole point of this is it's never too soon to start saving, right? The vast majority of us, when we get out, want to know how do you invest in a hedge fund to, get rich, right? Or what stock tip do I have for you to get rich? A single investment is not going to do it for you, right? The biggest way to get rich is to spend less than you make, period. You are the biggest source of wealth generation in your own life. And hopefully you'll find some interesting investments along the way and you find a good investment manager or you learn how to do your own investments. But simply spending less than you make, getting out of debt and not paying 23% on your credit cards is a huge win, right? And the sooner you do it, the better. And what this shows is it doesn't have to be a ton of money. $2,000 a year is not a lot of money, right? You can do this. And the sooner you do it, the better, right? Putting a little, obviously, if you spent $2,000 a year between now and the time you retired, you'd have a lot more money. But doing it now and letting that initial egg start building, is so much more powerful than if you had just waited until that time when you paid off the car or you paid off the house. You start saving now. Right? Yeah.
I was interested in investing in a low-cost index fund,
Haha.
but I was kind of curious because I know Warren Buffett vouched for them. But since you're a hedge fund manager, I feel like you have a bit of bias against them.
So, what a perfect segue into should you be investing in an index fund or should you be actively managing your portfolio? So, in the graduate finance class that I teach occasionally, we explore the essays of Warren Buffett. And one of his lessons is to say, if you are a know-nothing investor, if your job is managing inventory or managing HR or accounting, whatever it is, it's not buying and selling stocks or figuring out where to put your money, then if you're a know-nothing investor, the best thing for you to do is to put your money into a Vanguard low or no-load index fund and just kind of ride the market, right? Because even though the market's going to go up and it's going to go down, if the American economy is going to grow over time, your indexing into that fund is basically your fractional participation along with the growth of the American economy. And so he basically says if you're not going to spend the time to really understand how to invest, then that's the best thing to do. However, he then quickly says, on the other hand, if you're a know-something investor, able to identify the businesses with a competitive advantage that are likely going to be here 10, 20, 30 years from now, be able to understand the basic valuations of those businesses versus others. If you spend more time thinking about investments than you do mowing your grass, which very few people do, then simple diversification into index funds makes no sense for you. And the reality is most people aren't willing to spend the time to become a know-something investor, and so the first bucket makes sense. But for those of you who are, or if you can find someone, I'm not saying that I am, right? But if you can find people who they spend their time, truly understanding what makes a good investment or not, and they have a track record of exploiting those differences, then there's an alternative, right? And while most endowment funds have a really hard time hitting their 5 or 6% benchmarks, having a lumpy but realized 10, 12% compounded annual growth rate is not something I think that's out of bounds. Right? Our own CAGR is much higher than that. Or our own hurdle rate, we try to do something closer to 20, but for the average person, getting something close to 10% should be very attainable, right? And that creates something like that being very, very realistic. Okay. So a lot of people say, well, how can that be? I want to tell a little story of a guy by the name of Joel Greenblatt, who, like me, ran money for a while and now runs an index fund and also runs a hedge fund. And so he kind of does both sides of these equations, right? But he has a story where he sat down with a bunch of 8th graders. And, they were 8th graders taking algebra. And so they were your above average 8th grader, right? They're not your dullards of the average 8th grade population. But they're not Math and Science Academy kids either, right? So they're not freakazoids on the other end of the spectrum, right? And so the first thing he does with this class of 38th graders is hands them this jar of jelly beans and gives them each 2 minutes to study it. And when he starts to basically guess how many jelly beans are in the jar. And, through some very basic math, height, width, volume, how many rows of jelly beans, how many columns of jelly beans, all these kids write down on an index card what their estimate of the jelly beans are. Then he goes around one by one and says, Sage, what's your estimate? 900. Right? Or Devin, what's your estimate? 2,000, right? Or whatever it is, right? And as each person goes along, the student is able to update their original answer. And some interesting things happened. Joel Greenblatt tallied all of the original responses. And there was like 1,715 jelly beans. And some were high and some were low, but based on fairly basic studying of the real thing that was in front of them, they came up with 1,705. So they didn't peg it, but on average, through some fairly basic math and very basic analysis, they got pretty damn close to how many beans were in the jar. But then, as the social influence of Devin saying something, and David saying something, and Benjamin saying something, and Sage saying something, the average reported final estimate was about 850. And Joel says that's the stock market. Every day, there is an opportunity to figure out what something's worth. How many jelly beans are in the jar? And through some fairly basic math, you can figure out what this business is worth. Or you can say, the jar isn't clear. It's black, right? I can't see into the jar, and so I have no idea how to estimate it, and you just kind of move on to something else, right? So that's an option as well. But for the clear jar of jelly beans, through some very basic math, you could say, that's what's in there. But every day, we get influenced by all the other guessers around us. And that's why the prices jump up and down and up and down and up and down. And sometimes, over time, those two things converge, right? There were some people that even though they wrote down 1,700 and everyone else was guessing 850, they still submitted their card at 1,700. But on average, most of us are influenced by everything else that we're seeing on Facebook and Twitter and in the Wall Street Journal and in our classrooms. And Joel said this was his best analogy for the stock market. For folks who can just basically stick to, can I see the jar and can I do some basic counting? Then you should be able to figure out what most things are worth. And if you can put your money to work in things that are worth 1,700 jelly beans, but you can buy them at a price of 1,500 or 1,000, you're probably going to do pretty well. But if you're buying 1,700 jelly beans for 3,000, you're probably going to do pretty poorly. And every day you have all of those scenarios playing out. You've got companies that have 1,700 jelly beans and people are only willing to guess that there's 850. And there's other companies like Tesla that people think are worth 1,700. They're only worth 1,700 jelly beans, but they think they're worth 10,000. And you've got to be able to sort out the noise. And if you can do that, then you're a know something investor. If you can't do that, then you're a know nothing investor.
So don't be swayed by emotional skew.
Yep, that's one of the big influences in the market today. Social finance. Right. All right, that's my words of wisdom to leave you with. So let's finish the final exam. One of the key concepts that we talked about early on in Chapter 13 was the relationship between the number of purchase orders when you're buying inventory and the actual number of inventory, right? And they're kind of inversely related. Right? As one goes up, the other goes down. So if I buy more often, I'm going to incur more purchase costs, but I'm going to have a lower level of inventory. If I purchase less often, I'm not going to be incurring the cost of placing the order, but I'm going to be holding more inventory, right? And so that's just kind of a fundamental concept within the economic order quantity model. Using leverage to juice your returns is a really poor way to drive shareholder returns from an operations management perspective, right? That is a way to increase your return on equity, but that is likely not sustainable over a long period of time. Inventory affects return on equity through all three dimensions of the strategic profit model. It affects sales. Right? If I have more inventory closer to my customers will probably buy more from me because I can give them a higher service level. If I have too much inventory and I'm financing that inventory with really high costs, I might have a higher expense rate. Or if I'm not using effective transportation and moving my inventory around, my expenses can be affected by my inventory. And then obviously my asset utilization is affected by it because if I have more inventory, then that bloats my assets. Whenever I'm considering the strategic profit model, we'll talk about that in a minute, I also need to consider taxes. Right? So most of you all adjusted the expenses piece correctly, but also remember that Obama or Trump, whomever they are, will take their cut along the way. Okay, lots of different reasons to hold inventory. We should be familiar with the reasons for why people hold inventory, including things like speculation, anticipation of future costs going up. I should know all the dimensions of inventory carrying costs. Most people focus on the inventory capital costs, right? The amount the bank charges me to borrow to hold this inventory. But there are other things like taxes and insurance, things that feed into service costs. Things like storage costs in my warehousing, risk costs, things like obsolescence and theft and damage, right? All that stuff plays into my inventory carrying costs. Quiz 10 really focused on deviations of the very standard EOQ and total ordering and holding cost model. These are the very simple equations, right? What's my economic order quantity? What's my total order and holding costs? So that was quiz 9. Quiz 10 then took the derivation of these things and said, how do they change for special quantity discounts? Know the difference, right? If I've just given you one price, one quantity, right, a fairly limited set of data, all I'm asking for is typically the traditional holding and order placement costs, right? But if I add other things like price discounts or special one-time savings, right, that's when the more complicated formulas come into play. All right. Okay. One of the benefits of the economic order quantity model is it's fairly tolerant to you screwing up, right? So fairly large errors in forecasts result in fairly modest implications to our inventory, our total inventory holding and carrying costs, right? So it can be, off by a lot on my forecast, but my holding costs and carrying costs don't change very much, which is pretty good to know. All right. This is probably one of the most important concepts everyone should leave this room with because it's a really simple model that can be the whiz-bang expertise that everyone knows. If I'm trying to figure out the change in my economic model going from a certain number of locations, I want to know the square root of the number of locations. And I look at the square root of the two locations and the square root to the from locations. So let's look at two scenarios. So let's look at scenario 1. Let's say I've got $1 million of costs today. And today I have 16 warehouses. And tomorrow I'm going to scale those up to 25. So just in general, I'm going from 16 to 25. Are my costs going to go up or down? Up. because we're going to be spreading our inventory across more locations. And the ratio of how much it's going to go up is going to be the ratio of the square root of the 2 locations. I'm going to 25 from 16. So square root of 25 is 5. Square root of 16 is 4. So this is going to go up by 1.2x. So if I had $1 million of cost before, my new costs are going to be $1.2 million. Or they're going to go up by $200,000. Okay. Conversely, if we had a scenario where today I've got 9 locations and tomorrow I'm going to 4 locations, well, if I'm going to 4 locations from 9 locations, then my costs are going to be 66% of what they were, so they're going to go down to $667,000. Right? If they were $1 million, they're going to go down by 1/3. So I could ask you, what's the total costs in the new scenario? What's the total cost in the old scenario? What are the savings? What are the increases? Any of that relationship, right? It all changes by the square root of the number of locations. Square root of 2 over the square root of from helps you understand that ratio. Okay? I want everyone to get that one right. We'll see something like that on your quiz, on your exam. Okay. We talked about this already, kind of one-time savings, discounts. You need to be able to calculate inventory turns. You may be given the income statement and the balance sheet for a company. You may be given the income statement and the balance sheet for multiple companies. And you're going to have to compare who has the best inventory turns. And so you need to understand inventory turns are a function of the cost of goods sold. That comes off the income statement. And it's going to be a function of the average inventory over those 2 periods. Right? So the beginning inventory balance, the ending inventory balance, add those up, divide by 2. Right? I can get my inventory turns for the period. So you might need to do that for one company, you might need to do that for multiple companies and compare them.
I have a question about that.
Yep.
Where on the sheet do you
Okay. So the income statement is going to start with revenues. You may have then some deduction of gross revenues versus net revenues if there are some sales discounts. And then you're going to have something called cost of goods sold, and then you're going to have gross margins, and then you're going to have all kinds of operating expenses, and then you're going to have operating margins, and then you're going to have taxes and interest and all that kind of stuff. What you're looking for is cost of goods sold. And so on the left-hand side, we see total net sales of $12.5 billion, and then the line underneath that says cost of goods sold. That's what I'm looking for on the income statement. So basically $8 billion under this scenario. Okay. On the balance sheet, you're going to be looking under the current assets part of the. So you got long-term assets, short-term assets, or current assets. Those are the same name. You're going to see things like cash, securities, accounts receivable. You should also see something in there called inventories. It may just be something simply called inventories. It may be called merchandise inventories. Under this one, we see cash in the bank, short-term investments, deferred taxes, prepaid expenses. We also see something called merchandise inventories. That's what we're looking for. We're looking for the beginning number of merchandise inventories. We're looking for the ending number of merchandise inventories. And we're going to take the average of the 2. Other questions? All right. Strategic profit model. We ought to be able to pull a lever somewhere on this model and see how it affects our return on assets, return on equity. Don't forget the taxes. All right. So under this model, if my gross margin previously was $45 million and my total expenses were $35 million, well then that implies my operating profit or my profit before tax was $10 million. Well, if my taxes were 5 out of 10 is 50%, right? So I'm paying a 50% effective tax rate, very common in California. So if I were to identify some savings and my profits went up, right? So 45 minus 30 would be 15. Well, 50% of 15 is 7.5, and that's what flows through the rest of the model. Okay. What do you need to do on your final? Take your total points, and you can either just go to the total points column, because it should just be sitting there on gradebook, or you can look at the weighted average total points, which is a percentage, and multiply that by 80. All right, those numbers should be the same. And then figure out what you need to get on your exam. Let's say you're sitting there with 60.8 total points today. In order to get an A, you need 90 points. Well, that would mean that you need to get 29.2 points on this exam. Well, there's only 20 points, and so it would be not possible for you to get an A under that scenario. If you wanted to get a B, you need 80. Well, 80 minus 68 is 19.2, and so you'd have to do really well on this exam. You'd need to get 19.2 out of 20 to get a B. If you wanted to get a C, you'd only need to get 46% under this scenario. And if you wanted to just kind of phone in a D, I'm not quite sure why you'd want to do that, but you wouldn't even have to take the final. This is just an example. This is not your grade, right? But this is how you kind of go figuring out how well you got to do on the exam. Okay? There's 20 possible points left. You know what the grade breaks are. You can figure out what you need to do on the final to get what you want to get. Excuse me? Can I say it again? So let's say you're sitting there with 60 points today. There's only 20 points left. Well, 60 plus 20 is an 80, so you'd have to get 100% in order to get a B. Right? Final's only worth 20 points. Now, one of the things that this doesn't take into consideration, if everyone bombs the final, then there'll probably be a curve. And so for those that do well in the context of everyone bombing, you might be curved up. But given that a lot of these questions you will have seen now for the third or fourth time, my expectation is we don't have a lot of Fs on the final, but you might surprise me. If you have any questions, come and see me. Have a good summer.
It's a real pleasure.
Thanks, sir.
Thanks again for putting in this.